Are you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. My podcast is to help you understand the mortgage loan side through my experience and knowledge. My name is Paige Ashby. What is a mortgage? Let's go over the 4 basic factors so you can have a better understanding of owning a home. Let's get unpacking. A mortgage is an agreement between you and a lender that gives the lender the right to take your property if you fail to repay the money you borrowed, plus interest. Mortgage loans are used to buy a home or to borrow against the value of the home you already owned. There are 4 key terms that are involved in a mortgage. The first one is called payment. Principal, interest, taxes, and insurance, known as PITI. These are the 4 basic elements of a monthly mortgage payment. Private mortgage insurance, PMI, is a type of mortgage insurance that benefits the lender. This protects them if you default on your loan. The second term is called escrow account. Taxes and homeowners insurance. When you buy a home, the lender will collect a full year of your home insurance premium. Then the lender is required to start an escrow account. This account will be used to pay out your insurance and taxes when they're due. The purpose of this is so they don't ask you to come up with the money out of pocket. Now, on a purchase transaction, the lender will collect about 5 months of taxes and about 4 months of home insurance. This is on top of the 12 months premium that they have to collect. On a refinance, taxes will be collected based on the month that you close. Of course, taxes are due twice a year, February and June. And your home insurance is due depending on when the policy is binded. The third term is interest rate. Interest rate is the cost you will pay each year to borrow the money, expressed as a percentage rate. It does not reflect any fees or any other charges that you may have to pay for the loan. Now, an annual percentage rate, APR, is a broader measure of the cost of borrowing money than the interest rate. The APR reflects the interest rate, any points that you have to pay, mortgage broker fees, which is also called origination fee, and any other charges that you pay to get the loan. For that reason, the APR is usually higher than the interest rate. Now, the last key term is called terms. A mortgage can typically be as long as 30 years or as short as 10 years. The short-term mortgages are considered mortgages with terms like 10 years or a 15-year. Long-term mortgages usually last 30 years. Is it better to get a 15-year mortgage or to pay extra on a 30-year? People with a 15-year term pay more per month than those with a 30-year term. In exchange, they're given a lower interest rate. That means the borrower with a 15-year term pays their debt in half of the time and possibly save thousands of dollars over the lifetime of the mortgage. Now, if you don't want to take the risk of having a higher payment on a 15-year mortgage, you can keep your 30-year mortgage and make extra payments. Most of my clients, I recommend them make $200-$300 more, but make sure you put it towards the principal only. That will take your mortgage down too. And also, if something happens, you can always go back to your 30-year payment. If you have enjoyed this information, make sure you give me a follow. And if you have anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and mentor, if you have any questions or need a pre-qualification, you can reach me through LinkedIn, Paige Ashby Lending. And my other contacts are listed below and in my episodes. Thank you for being part of Unpacking the Home Advantage.